Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller. So where is this market? What's going on? Nobody knows what they should do about real estate. Should they buy an apartment? Should they buy a building? Everybody's worried. Everybody, Barry, give me an apple. They're worried, give me an apple, please. They're worried that values and everything's dropping. They don't know where it's dropping, what's going on. So as opposed to my traditional show where I try to bring real estate experts, I brought people who have been involved with every aspect, including owners of real estate, to talk about their view of what's happening in the market. Today, my guests include Barry Akrongold, Chairman, CEO, and President of Fortune Financial, Ralph Hertzger, President and CEO of Meridian Capital Group, Scott Major, Chairman and CEO of Perfect Building Maintenance, and Chairman and CEO of ShortPath. And last but not least, my good friend who's been behind my shows ever since day one, Jim Orphanides, Chairman Emeritus of First American Title Insurance. So, Jimmy, since you and I are the oldest people here, Ralph could be as old as us, but you and I are the oldest, how do you see this real estate market today and the economy today in your close to 40 years of business?
Michael, the economy is something I think there's a lot smarter people out there that are trying to make that judgment, but we're suffering today. I think everybody's nervous. I think anxious is just a fair statement. I think people are worried about their jobs more than anything else in today's market. I think that's a nationwide issue. When we bring it home here to New York, I think everybody's worried about just what's going on in the financial service area and how it will impact all of us. And with the job losses that we've seen so far, is it over? And I don't know that it's over. And I don't know that we're at the bottom yet.
Scotty, Perfect Building Maintenance does janitorial maintenance and a lot of other things, but I mean, you have a lot of business in Lower Manhattan, you have a lot of business in Stamford. What do you see happening with what Jim just said with the financial service industry? Stamford is big financial services and Lower Manhattan is a big. What do you see?
Even in Midtown, Michael, we are seeing tenants in buildings that are laying people off and there is space going dark. It's not impacting on the landlords. They're still getting paid. They're still collecting their rents. But there is a cutback of services. It's come back. It's switched over from being about service to being about price. And people are looking to us to try to cut back wherever we can to help them save money in their offices.
The show the prior week we were talking about Lower Manhattan with the loss of AIG, AIG, Merrill Lynch, and the combination of Goldman Sachs. What happens? It could be vacant. What happens when some of these companies go bankrupt? Okay, basically AIG is bankrupt.
We are coincidentally working with AIG right now on 72 Wall, 70 Pine, and 175 Water Street. And the mandate is to go and to try to implement a massive reduction in services for the AIG properties. They're government owned now. Their stocks have gone from $70 down to $1.69. The look and the work that we're doing right now is to look to cut services where we can, to cut staff where we can. It's permeating throughout Lower Manhattan, throughout the financial services.
So, Ralph, Meridian is, in my opinion, one of the leading national mortgage brokerage firms, and you've put out a lot of money. What do you see in your 25 years that you've been in the business? How do you put this into the years in the early 90s and so on?
Well, I think every cycle has its differences, and I think this is a lot different than the one in the 90s.
Better or worse?
Still remains to be seen. There was more contained. There was more of a savings and loans crisis, which affected real estate. Where here it's really a capital market crisis and liquidity crisis. Which
so
is
isn't that
affecting real
perhaps
estate.
worse?
Potentially. I mean, the numbers are much larger. The transactions were much larger, and in the early 90s, Wall Street didn't really play in real estate finance.
Jimmy, in the early 90s, First American, whatever the preferred agency before First American, what happened? What was happening in the real estate business, in the financing world over then?
Well, from a New York perspective, we saw a tremendous transference of wealth throughout the United States, with the RTC taking over and making sure that money was distributed throughout the country. That replacement of money would not necessarily be felt in New York. The thing that saved us here in New York, I think, was the clear opportunity that arose in values being so low, and there was like the cycle that hits the bottom. There's only one way to go when you're at the bottom, and that's to go up. We had different indicators there, and I agree with what Ralph said. There was a contained environment. It was mostly a savings and loan and a real estate impact on the nation, with failed loans, bad practices, bad discipline, and just a failure of leadership. And today, I think right now we're worried because some of the biggest houses, the people that advised us, the people who led us, the people who guided us, Wall Street was dictating a lot of things to corporate America. These were the people that were giving us our cue cards on how to behave and how to conduct business. And I think now we have a total opportunity to start all over again and build a much better economy for ourselves with a much better standard of quality and perception to go to excellence.
We talk 1990. Barry, 1990 was a good time. You started in 1990. I don't want to call you, as I said prior to the show, a little
started
bit.
Early. I know
you started in the 80s. But, you said to me, it was a good time for bargains. What happened in the 90s? And let's talk about how you look at 2008 and 2009.
The early 90s were really it was a great era for buyers of property. The problem is most of the people who owned property had so many problems that they were constrained from taking advantage of all of the opportunities that came up. But I think when people say, it's really a great time to be buying real estate assets. Now, I'm not saying it's a great time today, but I think the smart and intuitive entrepreneurs that now start to track deals early on, because this cycle is very early in its stage. This is sort of the end of what's been an extraordinary upcycle. Now is the time. The great real estate moguls will emerge out of this time, and not just real estate moguls. I think also even for the individual consumer, it's a great time to be looking for a house or looking for a condo, because when everyone else is running out, that's when you want to run in.
So the big question is it the right time? We're taping the show on December the 9th. The show is going to air like January 1st. Is January 1st, from what you're saying or what Jim is saying, okay, is it a time for somebody to go out and buy an apartment today?
I think it's very early in the stage of the restructuring of the real estate market. But my advice to people would be to not think macro, think micro, because there's great deals in the up market and there's great deals in the down market. You may find someone that's constrained for some reason, needs to sell quickly, and it still may turn out to be a great deal. I hate to
say, is a one man's fortune is one man's misfortune?
No, I think that there's just opportunity for everyone. And even people who have troubles have the ability to look beyond the troubles and say, okay, even though I have troubles here, I still may have an opportunity to buy this at a great discount. If it was good at $1, it's certainly going to be good at 30 or 40 cents on the dollar.
I know that Scott owns a house in New Jersey, owns some property in New York City. You know, you own some apartments in New York City, and you also own some office buildings. You're a partner in some buildings. Are you scared a little bit about some of those office buildings and some of the other properties that you have today?
On the income-producing properties, I don't think there's a real worry at the present time because they were based on, they're based on good rent rolls. How that turns around.
What happens if some of those tenants move out? Okay, well,
I think what you're
Jim
looking at-
Orphanides has a great company. He's ran a great company at First American. Now he's chairman emeritus. 2 weeks ago, a company called Land America, a very good company, who everybody thought was strong enough, went out of business. Ralph, you and I had dinner in September. We were sitting there trying to enjoy our dinner, and then WAMU went out of business. Who knows what a strong company, what the good cash flows are?
Well, I think in terms of companies and cash flows, everything seems to be worth half. There are good companies out there looking for financing right now that can't get them. It seems reputations are worth half. But I think what you have right now is a new administration coming in with a commitment to infrastructure that's going to create jobs. I think money will be coming back to New York, and that will help our economy. That'll help the opportunity. Whether it's the right time to buy something now, or especially if you're looking at a home or a condo or an apartment, if you can get financing, it might be. I don't know if you can get financing.
So now we ask the guru, financing. Tell us, is there money?
There definitely is money out there.
Under new terms, under new conditions? What's the
much
rules?
different terms. I mean, today it's the finance world has gone back 10, 15 years. It's back to traditional lending. It's back, who's the borrower? What's his history? What has he done? What's his plans? I mean, cash flow is king. Till now, in the last few years, it was asset-driven. Price per square foot dictated a value.
Nobody cared about anybody. They just said, hey, this was the property. They didn't look at the borrower, did they?
I think they cared, but I think as the market covered up for a lot of errors that were made in financing.
But Ralph, certain properties haven't really been affected yet. We haven't seen the losses. There are over-leveraged properties. Certain buildings that were bought at a peak. I mean, the good example, look what's happened recently. Every one of the equity office properties that were sold around the country has basically been in trouble. We've had circumstances. There are office buildings that have been acquired in New York City based on future rentals. We were talking before, and I think even you did you do the financing on 666 Fifth Avenue?
I actually did not do that.
Okay, but 666 Fifth Avenue is a very good example. When those individuals bought the property, they thought that, and I'm not saying it wasn't possibly there, that the property on 666 Fifth Avenue, the office rents, would be $130 a square foot, right? They would say, Jim, at your building on 3rd Avenue, the rents now would be $80 a square foot. Jim, I know you and I were talking about rents. Rents are not that, right, Jim? I mean, today, you can find an office space on Park Avenue in a good building. You can negotiate for $60 to $65. They were $100 a foot. I asked Mike Fascitelli 2 weeks ago on my show. I said, you bought a property last year at 350 Park Avenue. I agree, it's a great location, for $1,000 a foot. Because you said you couldn't replace it. Now you got a big problem. So what happens when somebody comes to you, Ralph, and says, I'm looking for a loan? How do you advise them?
Well, that's a difficult, when someone comes in looking for a loan, it all depends. I mean, my advice to clients in this market is if you don't have to finance, wait it out. I mean, but there are acquisitions that are going on, and they are getting financing, and the banks are lending to good, solid borrowers. New York is unique. You have some very substantial owners that sat on the side and watched these prices go through the roof and said, I'm not going to buy, and now are stepping back in. So they have equity, and when they're going to put 35, 40% equity into a deal, they will get financing.
Scotty, you know some of the owners that Ralphie's talking about. What do you see them? How are they looking at it? I know you have owners in Lower Manhattan who've owned property, for 30 years, 40 years. They've always been quiet. They've been modest. They've been humble people.
I think there's still a lot of private equity sitting on the sidelines looking for opportunity, and I think they're ready to pounce. I think there are people that are sitting around waiting to buy. They're looking for their opportunities, and they're tracking the market, and they're tracking what's going on. New York is still a very, very unique place.
I mean, Barry, besides being chairman of Fortune Financial, you're also president of the YPO New York chapter. So you got all these people in YPO, Young Presidents Organization. What are they looking at? They probably come to you and they say, hey, you're in the real estate business, Barry. Well, what should I buy? What do you tell them?
I tell them that the opportunities are not just going to come to them. It's not like it's just all of a sudden going to happen. You have to start creating. The good real estate people create the opportunity. You start tracking a litigation, or you track something with trouble, and you in the mix of that, you can create something. I think the challenge for most people, like many of the presidents of companies, is a lot of people have businesses that have debt and things that were done in the last 7 years. So the challenge is, how do I balance my existing business and survive, and then at the same time take advantage of all of the great opportunities that are coming up? So that's sort of the balance that I think a lot of people who own their own companies or are president of companies are facing.
You know, Jim and I know of a number of very bright financial people who have done very well, who made some errors in the last year or two. I mean, some financial geniuses, basically. You know, there are companies like Gramercy Capital, who's really in a lot of trouble. All of these mezzanine loans, all of these other things. What do you see? If you had and I know it's not a crystal ball, what do you see the values of New York City office buildings? Do you think we're down 10, 20%, Jim?
It's conceivable that we're down as much as 10 and 20%, Michael. I'm not sure we know what the bottom is. I really don't know that we have hit the bottom yet. I think there's a word that I remembered a long time ago being talked about or batted about called deflation. And, you know, synthesized 101 version of deflation is nobody knows what the real bottom value is. And if you bought something today, took a car off of a parking lot of a dealership that cost $40,000, and the minute it reaches the curb, it's only worth $20,000, that's an indication that its value has been diminished. Today, we don't know to what extent values are being diminished. And real estate used to be a certain fixed cost, which you could manage and navigate when you scaled it out. Today, the fixed cost may be exceedingly high to what other operating costs are, and now you're facing a different kind of an issue. As Scott mentioned earlier, there's a lot of office space that's going to go dark for a while that may still have, for short-term periods, the ability for the tenant to pay, assuming that they're going to be able to sustain that. But again, I'd be worried right now about space being empty, the loss of jobs. Again, going back to the fundamental, I think the most important thing for our government is that we're going to have to make sure that we encourage businesses to hold on to those jobs and to figure out a way to keep everybody as often and build up the employment rank instead of losing the employment rank. It's really critical for all of us to see this as an employment issue more so than it is a profitable issue. And today, Wall Street has been transformed. It's now going to be a different institution than we always knew. So there's a lot of great future in front of us here. It's just got to be managed and controlled and involved, and the government has gotten very actively involved. I'm not necessarily saying that I would favor the government's activity up until now, but they are in the game. Now that they're in the game, I mean, they're the best partner that anybody could ever hope for, because at least they understand they're going to look at the whole picture, and they're going to try to address the needs of the people. And I think we'll see it. Scott mentioned infrastructure. I think they're going to encourage financing. They're certainly putting money into a lot of places. Now it's time for people to stabilize and just get control so that they can probably go about doing the business, but it's going to take time. There's nothing. We didn't get here overnight, and we didn't get to this point overnight, and we're not sure it's over. So it's going to take time to work through the problems. Be patient with yourself. Be patient with your colleagues. Be patient with your customers, and I think it'll come out that it will all be the better for it. And New York will be New York, the greatest place in the world to be.
You know, the show, and I agree with your points. The show the week before, when I had appraisers on, I know Ralph lives in Brooklyn. I grew up in Brooklyn. Barry's owned some property in Brooklyn. You grew up in Queens. Scotty was in Long Island. Brooklyn, some of the appraisers said there are so many units coming on in downtown Brooklyn. I mean, you drive through Brooklyn coming to the work. What do you see happening in the boroughs in Brooklyn? And specifically, you know,
well, I think
Queens.
one of the things that happened is as rents went through the roof in Manhattan, the boroughs became more popular. That's going to be tricky, but I do believe that New York is New York, and you know, you still have people constantly moving here, and they need to rent apartments. Rents might come down a little bit, but I don't think you'll see huge vacancies in the tri-state area.
You know, but you bring up an important fact. You know, a couple of weeks ago I did a show, and I had Steve Siegel and Steve Witkoff. people have to rent apartments. But even the multifamily, the Queens multifamily, the Washington Heights multifamily, or the Bronx multifamily, if someone who was working for DHL is out of business, or somebody was working, I saw in the Post today, they said there's an unemployed accountant making $36,000. If these people get laid off, even though they may have been paying $1,100 in rent or $800, they may not be able to afford it. So who's going to take over those apartments, Ralph?
Well, again, there's a lot of different industries, which is one of the uniqueness about New York. You still have some vibrancy in the city. It's a small city with a lot of people, a lot of students. I have some instances where clients have had, buildings that they built, and we financed them, taking out construction loans, and I'm amazed how quickly they've rented. Spoke to a client yesterday who told me on a major project in one of the boroughs, he's 1%, his vacancy factor is 1%. Now that's, you still have rent stabilization.
That's an anomaly, I'm sorry.
Yeah, but you still have rent stabilization in New York. So, even in the high-end stuff, while you might have some vacancies and turnover there, $1,100 for a one-bedroom apartment is not a lot of money, even in New York City.
It all depends on the income level. Barry, what are you seeing? You and I were talking a couple of weeks ago about Lower Manhattan. Scotty and I were talking before. What do you see, in the residential in Lower Manhattan? Any thoughts about that?
Yeah, I think that most of the deals in Lower Manhattan that were sold at $1,000 a foot and better, developers having trouble closing. And I think that a lot of people are under pressure to sell, and you're starting to see wholesale blocks of these apartments being unloaded for 30, 40% discounts, and I think it's the early stages of that. I think that that's going to continue because many of these deals were structured with very high interest rates, and I just see more and more. And I think if people didn't have more units on the contract that they were under fear that they would lose, they would be offloading stuff even quicker. I think that's what's holding people back, is they want to close the deals that they sold at $1,100 or $1,200 a foot. But I think that
but that relates to another very interesting point, which I haven't discussed on the show, but I want to bring up right now. There are people under contract to buy units, and there are a lot of people who are walking away from their 10% or their 20% contract. That's a big item because people feel that the values are down, they're worried about their job, and and I think part of the situation, and that has to be taken as a direction. I mean, you live in Princeton area, you live in the Tenafly, Englewood Cliffs, Englewood area. Now, Princeton, there's a lot of construction over there, a lot of the properties. The workforce housing over there, they're hurting. The Toll Brothers, the other.
The major builders are not able to really finish their projects, and to the extent that Princeton is supported with, of course, the university that we have down there, but we also have a large population of Bristol-Myers Squibb executives, Merrill Lynch executives. We're worried about those, and if those houses get altered substantially,
and I
a
think
lot of job losses.
Merrill Lynch, I think, Jim, it's a great comment. These Merrill Lynch executives, Bank of America, he runs a great operation. He's not going to keep all these jobs over there. There's going to be attrition. There's going to be certain problems. I mean, Bergen County, people can't sell houses in New Jersey.
There's a lot of for sale signs up right now.
Mm-hmm. The Hamptons. People aren't selling. I mean, values are down substantially. I mean, Ralph, it's nice to know there's money out there, and and I know people who come to you because you've done a great job for a lot of my friends and clients and other things. But it's a difficult time, and the show that I had the week before, when the appraisers say we don't know what the values are.
Well, that is tricky. The banks are definitely being very conservative, and I think '09 is a very tricky year. I mean, values can stabilize, they can come down. I mean, we don't know what happens. I walked into Saks the other night and saw a coat for sale, and it's marked down 40, and I said, when is it going to be marked down further? And the guy took it to the back, came back, and he said, tomorrow morning, I'll give it to you now at 50 off. I said, that's the real estate market. No one knows where the bottom is. So at the end of the day, no one wants to buy. The real problem is they really
It's
are
going to
not.
be good. I'm going to use that in an article. I think.
They're really, and the stuff is not trading. When was the last time a major deal in New York City traded that can say, the difference in real estate market and the Wall Street is Wall Street every day you look at a screen, you see what the bid, you see what they ask, you can value a company. And that's why Wall Street businesses go out of business as quick as they do. Real estate, the values don't appreciate as quick as they do. They're not coming down as quick
Ralph,
as they do.
they used to appreciate.
But not as quick as, you don't buy a building when like a company goes public and it goes up 60% in 2 days. The reality of it is there is some time lapse between our industry and some of the other industries, and '09 is going to be the year that's going to determine the real values. You're going to see sales are going to have to happen. A lot of the equity that's in these deals are not going to be able to stay in the deals. They hung in there for '08 because '08 they had other profits. The first 6 months of '08 were a lot better than the second. But you're going to see deals are going to have to trade, and that's going to set the benchmark of where the values are.
So let's, in summation, how long is this crisis? When are we going to get better? When's the world going to get better, Barry? And I'd like everyone to give their thoughts on this. You're first.
18 months.
18 months.
2 years.
Ralphie?
I don't know what better means. This might be better than it was 2 years ago when everything was out of control.
Wait a second, Ralph. You would say it was better 2 years ago? You were making a lot of money. You were doing a lot of business. I mean, I'm saying better in the manner that there's going to be a financial transaction, that the economy is going to be a little better. I mean, is it 18 months? Is it 12 months?
I'm not here to predict timing, but I think '09 you will see that the government has taken such an active role. The banks will start lending. You will see activity. Sales will happen. There will be opportunities for people like yourself who will come in and buy this with fresh equity coming in, and there will be a tremendous transformation of assets from the buyers of '06 and '07 to the buyers of '09.
Scotty.
Right now, it's like trying to have a rational conversation with an irrational person. Nobody knows what the market's going to do. And I think when the lenders get back in and they start either putting new money into the markets or reworking some of the financing, then some of the private equity will get off the sidelines. But you look at some of the office REITs right now. SL Green was $100 a share, then it was down as low as 7. I think it's back up to 14 or 15. They're one of the largest
28.
office, 28. Great, it's coming back. They're one of the largest owners in New York. How can you get a 70% hit in the stock value? It's irrational.
Jimmy.
The world, I can't answer, but I do know that this is the first time in history that we do have a world economy where it's real time, real activity. I don't know what's going on and whether the world will have the same kind of economic issues that we face today. I do think that we should realize that we have a leadership coming about starting next year that will give us the encouragement and will encourage us to take the tough and make the tough decisions. I think we've got a great opportunity to build one of the best markets in the future.
Okay, I think we've had an interesting conversation. I'd like to thank Barry Ackengold, Ralph Hertzka, Scott Major, and James Orphanides. See you next week.
Thank you, Michael.
Thank you.
Thank you, Michael.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, Cushman & Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and Millichap, Massey Knackle Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, Newmark Knight Frank, Muss Development, Palin Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.